All right, everybody, we're going to get started. Thanks for being here with me today. My name is Geoff Bruskin. I'm the owner of White Tiger Connections. We are a brokerage firm. We do buy and sell side representation of public accounting firms primarily. Topic of today's webinar is mergers as a strategy. So mergers rather than acquisitions, and when are they valuable? When is it valuable to do a merger rather than an acquisition? And we're just going to jump right in. The main topic that I want to go over today with merger is really a merger is a longer tail strategy than an acquisition. So acquisitions in the specific public accounting firm context, which is what we're talking about today, are really more about short-term succession planning and exiting from a practice. Now, short-term could be you're ready to get out in the next 6 to 12 months. Rare that I see an exit, an acquisition that's faster than 6 months, because specifically within accounting firms, obviously what you're monetizing is your goodwill that you have with your clients. And it takes a period of time for that goodwill to be transferred over to whoever the successor is that's going to be taking over for your book of business. Um, so 6 months tends to be the shortest amount of time on the acquisition side. And an acquisition can really be, if you're looking to kind of get out of your practice anytime within the next 5 years. So 5 years would be a longer tail acquisition. Another main difference between mergers and acquisitions is that acquisitions are really liquidity events for you. So whether it's 6 months that you're exiting over in a post-integration context, or it's 5 years that you're exiting over, or anything in between, you're really engaging in an acquisition because you want to monetize. You want to liquidate your equity in your business. Um, Now, this is different than a merger. A merger, there's no cash that's exchanging hands. So in an acquisition, you might get 20% down or 50% down or 70% down of whatever the valuation of your practice is, and then have an earnout period, which, whether it's over 6 months or 5 years or anything in between, your earnout is tied to things like client retention. It's tied to your staff, and your staff being retained and your staff integrating into the new firm, the firm that's buying you. And all kinds of other things, technology transference, workflow transference, if there's a cross or an upselling component to how the buyer is looking at your book of business as value add to theirs, because there's ancillary services that they're also looking to add to your client base, or that they're looking perhaps for you to add to their client base. Whatever it is, these are the conditions of the earnout in the acquisition context, but there's an amount of cash that's paid to you down. And then over that period, which is the earnout period, remember, we're talking about acquisitions here, whether it's 6 months or 5 years, you're going to be getting a trickle of the remaining equity that's in your practice. Whatever is not paid to you is cash down, right? So acquisitions are really all about liquidity event. It's a liquidity event for you. A merger, on the other hand, is about the way I like to phrase it is 1 + 1 = 3, right? So it's the whole is greater than the sum of its parts. And most often, I see mergers happen in situations where both parties, party A and party B, are looking for continuity to keep working, to keep building together for more than 5 years. It could be 25 years, or it could just be 5 to 7 years. But if it's more than five, what I find is that there's enough horizon in the combined practice where it's not about the liquidity, the monetization of your equity that both parties have in their respective practices, or one party has in his or her practice. It's really about what can we build together, which is going to increase the velocity, the sustainability, the security, um, and the exponential, multiplicative or exponential nature of what we're doing on our own, perhaps in more of an additive context, single dimension of growth, and maybe there are multiple dimensions of growth that we can do together. So I'll give some examples of some situations where that's possible. One thing I see all the time is somebody's just burnt out, but they don't want to stop working. So, an accounting firm owner, whether you do tax, you do assurance, you do accounting services, really what you're best at is selling new business and serving clients at a very high capacity. I just had a conversation with a gentleman in Northern Florida, South Georgia. He has two offices. He runs about a $4 million book of business. And he's in his late 40s, doesn't intend to stop working anytime soon, loves what he does. He just hates the admin side of it. He doesn't like running the firm. And I see this all the time with accountants. You guys get into this profession because you like serving clients. You get into business ownership because you don't want to work for somebody else. And I understand both of those things acutely. The problem is that there's a lot that goes into running an accounting firm. So this gentleman, he's a perfect example. We'll call him Tom. Tom, doesn't want to stop. He wants to keep going, but he would like to merge with a firm that's going to give him the support so that he can do what he does best. And he doesn't have to worry about hiring and firing. He doesn't have to worry about anything unrelated to what he likes to do, sell business and serve clients, running payroll. If somebody quits, having to backfill the position, all of the admin stuff, which is involved with running the firm, he doesn't want to have to do. So we're looking at possible merger options for him now of some kind. It could be any number of situations, right? It could be with another public accounting firm that is maybe a little bit larger and has a sophisticated corporate infrastructure that is going to enable Tom to just do what he does best. They're going to be able to merge him in. It could be larger accounting firm. It could be a wealth management firm, an IRA or a broker dealer affiliate. It could be a private equity firm, right? So there's lots of different consulting firm. There's lots of different kinds of buyers of accounting firms. And any buyer of an accounting firm probably is also going to be open to a merger in certain contexts. It certainly makes modular sense to centralize the corporate infrastructure and empower the person who's running the firm to do what you do best rather than run the firm. So that's a very common situation that I see mergers take place in. You're burnt out on what you're doing. You're not burnt out on what you do best, which is, serving the clients. Another merger situation is where you see some kind of multiplicative opportunity, right? So I mentioned that before. So what does that mean? Let's say that you're a tax advisor and all you do is tax. You do, tax planning, tax advisory, and you do tax compliance as well. You have people who work for you who do that. Maybe you see the tremendous ancillary opportunity that exists in the wealth management function. If you have 100 tax clients and those 100 tax clients are $1 million in revenue to you, you work with relatively high net worth individuals, right? That's $10,000 a client. So these on an annual basis, these are going to be pretty juicy clients. And I have, plenty of clients like this who work with high ticket clients. There's a lot of assets that those clients have. And, you won't get 100 for 100 who are going over to also using a wealth management capability that's within your portfolio set. But a lot of them over a period of time will choose to work with the partner who you work with in a merger context who has that wealth management capability, maybe even other financial services like insurance, like employee benefit packages. Now, I get a lot of conversations with accountants about, is it a violation of my fiduciary in any way to be partnering with someone who's providing an ancillary service? And, it's funny because on the one hand, I totally understand why I get this question all the time as accountants, whether you're doing tax or accounting services. At Test, it's a little bit more difficult because that's a heavily regulated part of your profession. But certainly tax and accounting, too, you're dealing with very sensitive information and, there are fiduciary lines that you need to be cautious not to step over. There are rules that are coming out right now, which are still a little bit in flux, but it seems like, all wealth managers nationally are going to need to be fiduciaries. So there are some interesting implications here to this kind of partnership conversation. And I understand those. On the other hand, accountants as business owners are probably the most resistant profession to thinking about their firm as a business. As you're in this to make money. I mean, obviously you're in this to serve clients, and you absolutely do not want to step over any kind of line that's going to risk your license. But there are ways of navigating, not all, but a lot of the opportunities that exist in partnerships in the accounting space and ancillary spaces. You guys can make, orders of magnitude more money as a business plan. That's part of the conversation. Here's the even more interesting part of the conversation. The client benefits when you have someone who's sitting on the same side of the table with you, not a different side of the table, not meaning they're competing against the client or you, but if you have to work with a wealth manager and let's talk about maybe a client is going through a brokerage, of their business. There's the wealth manager, there's you, the accountant. There's, if you do if you're a fractional CFO, there's the tax person. If you're a tax person, there's the accountant that you have to work with. There's the lawyer. The more people who are on the same side of the table, the more communication is happening naturally between the two of you, the better the client is going to fare. So sure, we could approach this from a, standpoint where, yes, it actually is to the client, it's to your business best interest because there's, order of magnitude revenue opportunity for you, but it's very much to the client's best interest because you're not going to partner with anybody who's not doing a great job by your clients. You're going to do your diligence. So just in terms of how you think about this, think about it in the framework where it's possible. It's possible to have, these kinds of multiplicative value to the client and value to your business. And I get a lot of resistance to accountants who don't really understand, that, which makes sense because you're so focused on just fulfilling the obligations that you have for your clients. It's hard to have peripheral vision when you're running an accounting firm and thinking about strategy. So this is something that my firm does. One of the things that we do is consult with accountants to this end. Um, so that's, some of the value to a merger, tax and wealth management we see all the time, fractional CFO and CIO, technology functions or marketing, fractional CMO or in marketing functions. They're whether it's the entity or it's the life of the individual, there's tremendous possibility. Here's another huge opportunity that exists in the space. I have a client in Philadelphia right now. He runs about a $2.5 million fractional CFO firm and tax advisory firm. He works with clients, entities between 2 million and 20 million, doesn't do any unattached 1040. So it's a nice practice that he has, meaning the caliber of clients he's serving. It's not a super high volume, lower value client practice. He's working with somewhat sophisticated clients. And multiple times in the last couple of years, he's had his clients that he's had 10, 15 years in a CFO context exit. They've exited their businesses. Now, all of those liquid assets have gone somewhere else, right? $50 million manufacturing company sells for $80 million. Those assets are going to some other wealth manager. $100 million construction company exits for $250 million. Those assets are going somewhere else. So he's very interested. We're actively exploring partnerships for him right now, a merger with either a an RIA, or the custodian of affiliated with a broker dealer. He wants to be able to participate in those in that asset management. He's going to get his securities licenses. There are ways of even doing that without getting your securities licenses if you make it a consulting fee that you're taking rather than an annuity as a percentage of the assets that are being managed. But the same thing is true with insurance and all kinds of crazy, retirement planning, trust and estate sort of tax protection vehicles, which if you're a tax advisor, you're advising your clients on these things. But the space well enough to be dangerous, but you don't have to be able to deploy these solutions yourself. Mergers are often a very intelligent thing that you should absolutely be considering, because if you're in partnership with a competent person who can deploy these things that you're already advising your clients on, there's opportunity, as I said, for the client to benefit and for you to benefit. And these are, this is the other reason that I really see the merger. So the two, and this is, the crux of the conversation today. The two situations where the merger makes a lot of sense is number one, if you're burnt out, you don't want to stop working, but there are things that you're doing that you don't really enjoy. They're not the highest and best use of your talent. And number two is you see or you suspect that there may be strong client benefits to you merging with the firm that's going to offer a service or a line of services which are very aligned with what your clients need or are going to be needing over the next period of time, number of years. And it's also going to benefit you. It's going to benefit your monetization. It can benefit your succession plan. That's a whole nother topic of conversation, which we won't go into today. So those are the two situations that I see mergers successful in. So with that, I am going to open it up to questions. If anybody has them, please drop them in the chat here, and we'll have a nice short webinar. But would love to take any questions related to specifically the merger stuff is what we're talking about today. If I've been exploring both a sale and a merger to broaden my options, but realistically will end up with a sale, given my desired timeline, is it a waste of time to talk with those approaching me for a merger, or is it good to keep them in discussion to give me options if a sale isn't at the price I want, or it creates some scarcity slash demand? That's a great question. Um, it always depends on how much time you want to invest, right? This is really about timing, your question, which is a great one. Me personally, I would absolutely keep those merger conversations in motion. The reason for that is, as you said, it will give you options in the event you are not getting a sale at the price that you're looking for. The other thing is that it's going to educate you. So, at risk of spending too much of your time, if you are really bent on self-representing, my first and foremost advice, whether you choose to work with me or you would work with someone else, is that you should have some kind of investment banking slash brokerage representation, because there's a lot of value in terms of maximizing your valuation, even just the narrative structure of how your firm is articulated and the direction of it. Um, a good broker, a good investment banker should be worth 3 times plus their fee, plus give you tremendous peace of mind. But if you are really bent on doing this yourself, um, then I would suggest that if you can spare the time, you have as many conversations as you can. What's going to happen is you're going to mutate. You're going to get better and better at understanding the nuances of a deal, what people are looking for. So and that's really why good brokers and investment bankers are so valuable, because I, for example, have spoken to thousands of accounting firm owners, hundreds of RIAs and private equity companies that are interested in buying firms. So I, understand very well the nuances of how these deals have worked. I've also successfully executed a number of them. Um, so that's my advice. I would certainly keep as many of them in discussion with you as possible. To the extent that you can, that it's not emotionally burdensome for you, because that's always the other end of the seesaw. What are the criteria that make good merger candidates? I love that question. That's great. So, whichever you are open to, whether it's the M or the A, right? The merger or the acquisition, there are things that you can do to prep your firm for a more, and the way that you want to think about this is a turnkey transaction, right? Transaction, whether it's a merger or an acquisition. So, what does it take to create that turnkey element? Just a few things. Number one, you want to train clients into good behavior. So, good behavior of clients means you don't want to have a practice that is clients coming into the office all the time. You want to keep what makes your practice, real and has good DNA and all of that. Same is true with cultural nuances of your staff. You're really there to work. We work to make money. We want to be, efficient. These are the things that buyers and merger candidates look for. You want a practice that has an identity, but you don't want a practice that's over indexing on the identity side. The more digitized your practice is, the better. The more on paper that you have, the more on-prem, the more, I hate to say it, in office that you have. It's not bad if you have in-office employees or even that you see clients in the office, but um, you want the physical infrastructure specifically to be dealing with your highest value, highest paying clients, right? If there's going to be a justification for a merger or an acquisition, it's because there's that sort of thoughtful streamlining in your physical infrastructure is serving the most valuable part of your practice. And you should certainly have, if you have a in-office presence or clients that come into your office, you should also consider seeing clients remote and starting to train them into that behavior and allowing for a remote work option, so that with the talent crisis that we're all in today, part of your talent acquisition strategy, and I know a lot of you have been burned by this in the past, there is a way that remote work in accounting can be very effective. And I'm happy to do maybe a session on that sometime, to go into it in more detail, but not for today. I mean, think about the things that you would look for if you were to buy a practice, right? You don't want a lot of fat on the practice. You don't want a lot of waste. You want, your staff members to be well utilized. We like to see at least a 3-to-1 return on each staff member. 4-to-1 is even better in terms of what your cost is for them versus how much revenue they're contributing to for your practice. And I have firms in my network that have between a 7 to 10x return on their staff. That's pretty rare, but it does happen. So maximizing the utilization and the intelligence of your staff is another thing. And there's a laundry list. So think about the things that make your practice turnkey, right? Having a successor in place, having somebody who, if you were to get sick or disabled, who is able to kind of pick up and manage your clients, ideally someone on a partner track is fantastic underneath you in your book of business. A lot of people don't have that. And that's the reason why they look for the merger. Like the gentleman in Florida and Georgia who I mentioned, who at 48, he doesn't have a right hand, and that makes his life really difficult. Not only does he not like doing the payroll and the admin and the hiring and the firing, but he's the guy who's reviewing a lot of the work here. So, that means that he's got more pressure on him on the client relationship and the sales side, and he has all the pressure of basically running his firm on the other side. So it's okay if you don't have, a strong intermediate layer of staff. A lot of firms have like their partner group and then have associates, and they're missing that strong intermediate senior supervisor up to senior manager sort of layer. That's very common. That's actually another reason why a lot of people get into merger, is to bolster their operation and create stronger infrastructure and all of that, which I know you understand. So hopefully that's helpful and starts to answer your question. Okay, another question. With high-end accounting services where staff are paid 130,000 plus on average, does the 3 to 1 still apply? Absolutely. If anything, it applies more than ever. If you have a manager who's making, let's use easy math and say 150,000 a year, CPA manager, 150 a year, you're running a firm that's, I'm going to assume, under 10 to 15 million in gross revenue. If you're on this, maybe as small as a million, or even smaller. Um, if you're paying somebody 150 grand a year, they should be running a $450,000 book of business for you. And it doesn't have to be that they're there today, but that's kind of the direction that you want to be shepherding them into, right? You're in this to make money. You're not in this to break even. You're not in this to have a little bit of, fat left over that you can eat when the meat is gone. Because it takes labor. So just like in any business, professional services is no different. Accounting is no different in professional services. It's all about creating that order of magnitude through streamlining, through technology, workflow, and the staff that you have should all be about having, great client service, yes, but ultimately creating more value. Because the 150 guy, remember, he's got probably someone who's working for him, right? So maybe another $60,000 staff member, let's just say. Then you have technology. So by the time you're done, you're still only at 2 to 1, right? If that. Um, so, that's why 3 to 1 is really the bare minimum. And then you've got to review that person's work. They're not going to be 100% autonomous. So that's where, really 3 to 1 is the minimum of where you want to be. And that's where your mind should be focused on getting there and then beyond. Do demographics of your client base have high, medium, or low impact on your valuation? It's another great question. Um, Yes and no. So, I know of, so certainly here's the first thing. If you have a high value, low volume client base, like the 100 clients, 10 grand to pop, $1 million in revenue every year, that practice is almost always just going to be valued higher. On the other hand, if you have what, I'll call a retail tax practices, generally speaking, that practice is going to be valued lower. But if you have a retail tax practice that clients are trained into good behavior, your practice is digitized, you have some staff, that there's an operation that is healthy, it's quite possible that practice could go at the same valuation as the other practice that I just mentioned. That's possible. Unfortunately, what happens a lot of time is the practices that have the higher volume, lower value clientele, it's just a practice that's held together with sticky tape and bubble gum, right? And that's the situation where you're going to get the lower valuation. Just one more quick point on that. A bookkeeping firm that's dealing with clients that are between 500,000 and 2 million in revenue, right? Entities, and a fractional CFO firm that's dealing with clients that are between 5 and 50 million in revenue. Those two practices can go for the same valuation. Potentially, the bookkeeping firm might even be able to go for higher. And you might say, how is that possible? Well, if the CFO firm is being run by a CFO and he's planning on retiring, the that's a service, right? A person to person service, CFO to the business owner, and all of that goodwill is vested with that person who's retiring. Whereas on the bookkeeping side, if there's continuity and it's more of a merger situation, or even if it's a longer tail acquisition on the bookkeeping side, so clients, they're none the wiser. They never know that they've been sold, let's say. That's a stable annuity-based business that's not linked to a person who is ephemeral. So there's some nuanced evaluation. It's not necessarily one-dimensional. All right, all, we're at the half hour. Thank you so much for joining. Have a tremendous weekend. Hope to see you again on one of these webinars in the future. Take care. Bye-bye.